day, everyone. My name is James, and this is tutorial in Covenant University. So today we are going to be doing a topic in financial accounting, which is called partnership. Well, this topic is going to be very useful for 100 level students and also secondary school students. I believe we all have a certain understanding of what partnership means. So, firstly, in this course, we're going to be looking into the definition of partnerships, the features of partnerships, the advantages of partnerships, the disadvantages of partnerships, and then we'll also be looking at the partnership deeds and partnership accounts. So, first of all, I would like to define what partnership means. Now, according to Partnership Act of 1890, partnership can simply be defined as a relation that subsists between persons who come together to create a business for the purpose of profit making. So now, the main aim of a partnership is to make profit. Now, a partnership usually makes up of 2 to 20 people. Sometimes it will be more than that, but most times it's usually 2 to 20 people. And these people are professionals. It could be a partnership of chartered accountants, a partnership of surveyors, and a partnership of engineers. Basically, they are basically professionals, right? Now, also, we'll be looking at the features of partnership. One of the features of partnership is mutual agency, which means that every partner in the partnership acts as an agent, and so his actions are liable. All the partners will be liable for his actions. That's why it has a feature called mutual agency, right? And also, it's an association of individuals, meaning a partnership is formed by 2 to 20 people, just like I said earlier. And then it has unlimited liability. When a partnership has unlimited liability, it simply means that in the case whereby the asset of the business is not able to cover up for the liabilities of the business, the assets of the owners, who are the partners, will be used to pay off that liability. And then also, a partnership has limited life, which means that if, for example, the general partner or an active partner dies in the business, it's possible that the business could die, it could dissolute. Now, we're going to look at the advantages of partnership. Now, one of the advantages of partnership is that there's shared responsibility in decision making. As the saying goes, that two heads are better than one. When a partnership comes together, they can make better decisions, joint decisions that will promote the business. And also, there's access to more resources because each of them will contribute a certain amount of capital. And then there's shared risks and liabilities, there's complementary skills and expertise. Just as I said earlier, these partners are professionals, and so they bring in their skills to the business, which will add value to the business in the long run. And then they also enjoy tax benefits, right? So now, what are the disadvantages in partnership? One of the disadvantages in partnership is the complexity in decision making. Why is there complexity in decision making? Because there could be disagreements between the partners. They might not agree on a certain issue, and this cause complexity in decision making. It will even slow the decision making process, right? So there's also unlimited liability, which is also a disadvantage because there's a risk of the partners losing their personal properties to pay off the business liabilities, right? So there's dependency on the partners, and finally, there's limited growth potential. If you compare a partnership to a company, you will see that a partnership does not really have much potential for expansion compared to a company. That's why one of the disadvantages is limited growth and potential, right? Now, what are the key elements of a partnership deed? Now, first, let me define what a partnership deed is. Now, in a partnership deed is a document that shows the rules and regulations guiding a partnership. Every partnership usually have this deed, right? And some of the content of the partnership deed is the amount of capital to be contributed, the profit sharing ratio, the interest on capital, the interest on drawings, salaries to the partners, and the conditions for admission of new partners. All these things must be agreed by the partners because it's an agreement of the partners that is put into the partnership deed. It's a document. It can also be called article of partnership, meaning all the things, all the conditions that need to be placed in the partnership is put in that document, right? And then, in the case whereby a partnership deed is non-existent, there are certain provisions that will apply, and some of these provisions are there will be equal sharing of profit and losses, equal capital contribution, and then no partner can bring in or admit a new partner without the consent of all other partners, and then there will also be 5% interest on any loan brought in by the partner, right? So now, moving on to partnership accounts, there are certain accounts that need to be prepared when the preparing account for partnership. And number one, we have the fixed capital account, we have the current account, we have the fluctuating capital account, we have the loan account, we have the salary drawings and interest account. All these accounts are usually prepared for a partnership business. Now, what is a fixed capital account? A fixed capital account usually has two elements. It has a capital account and it has a current account. The capital account just shows the balances, the capital balances, and nothing more. While the current account shows the day-to-day transactions of the partnership, right? We also have a floating, or what they call a fluctuating capital account, right? In this fluctuating capital account, the capital balances and every other thing are done in that capital account. Unlike a fixed capital account that has a separate capital account whereby no other thing is put in, just the capital balances are placed in there, right? So now I would like to talk about the accounting entries that we all need to know. Very important when preparing partnership accounts. Number one is entries for personal use of stock. First thing you do is to debit the partner's current account and then you credit the trading account. Then expenses paid from personal resources. You debit the profit and loss account and then you credit the current account. Interest on loans by partners. You debit the profit and loss account and then you credit the partner's current account. Interest on drawings, you debit the partner's current account and then you credit the statement of distribution of income. Interest on capital, you debit the statement of distribution of income and then you credit the partner's current account. Statement of distribution of income is also known as the profit or loss appropriation account, right? Then partner's salary and profit sharing, you debit the statement of distribution of income and you credit the partner's current account. Then when there is share of profit, you debit the statement of distribution of income and then you credit the partner's current account. Where there is share of loss, you debit the partner's current account and then you credit the statement of distribution of income. Now, it is very important to know that these entries are very crucial when preparing a partnership account. So it is good that we all know these entries by heart when preparing a partnership account.